Hello, this is Rochelle Agatha, and this is the lecture on the master budget for managerial accounting. The first objective in master budget is to really discuss why managers use budgets. And from a textbook standpoint, this is going to give you everything you need to know. From a reality standpoint, I'll try to interject kind of what I know. Budgeting is a plan for a specific period of time. It helps management determine how to use their resources. It's used to estimate future costs and revenues. And here's a description. So you have a strategy, you have a plan, you act, and you control. And depending on what type of industry you work in, no matter what it is, from education to merchandising to a service business, this is the overall diagram of budgeting, no matter what the buzzwords are of the industry that you work in. There could be a rolling or a continuous budget. That's a budget that's continuously updated so that every 12 months of operations are always budgeted. I don't find this is used very often. Most organizations will create a budget and then they'll do a forecast, which is a true version or an updated version of where you are in relation to current operations. A participative budgeting involves many levels of management. Like I said, this is the buzzword that this book chooses to use. It has benefits and it has disadvantages. So the old fashioned way of budgeting was just the financial and leaders, executive leaders did budgeting. And then when you start adding all levels of management and you get more participation and more involvement, it's more of an interactive budgeting. There's a starting point for developing budgets. The prior year budgeted figures or actual results. So you either start with the prior year budget or the current year actuals. Or you have zero-based budgeting. And zero-based budgeting is common in government where you start, whatever you use it or lose it. Whereas in for-profit, even some not-for-profit, they look at where you stand. So if you budgeted something and you haven't used it, then it's just going to get taken away from you. The benefits of budgeting: it forces managers to plan, and it promotes coordination and communication. It provides a benchmark. Honestly, there is no way a company could succeed without a budget because you have to have a point to compare yourself to. A master budget is the comprehensive planning document for the entire organization. If you're in government, this is a very structured budget. If you're in education, it's a very structured budget. They each have their own name, but overall, it is a master budget. It consists of all supporting budgets. So depending on what you're talking about, here's your operating budget. You have sales, you have production, you have all the pieces that make up your production, then you have your operating, and then you have your budgeted income statement. So this is a picture, a diagram for you for a sales type of organization. Financial budgets then start with a budgeted income statement, excuse me, and they have capital expenditures, a cash budget, and a budgeted balance sheet. In what I find in industry more practical is you have a capital budget and an operating budget, and those are your two budgets that make up your master budget. But this book defines it down to these boxes, which is fine. Objective 2, preparing operating budgets. So you need your sales budget. And now we're going to go through the nitty-gritty. And I am going to talk relatively quickly because I know you can re-listen to the lecture and you can print the slides out if you need to. The sales budget plans for sales revenues in future periods, and it's the total number of units sold to be sold times the sales price per unit. And that gives your total sales revenue. So here's Exhibit 9-5, and I'm going to click away so you can see how it's calculated. You have your sales, your sale price gives you revenue, and then you have your cash sales, your credit sales is your total sales revenue. Notice the two tie. And then in February you have the same thing, and in March, and then you end up with your first quarter. So this is a typical sales budget, very simplified. Units times price divided into the type of funding mechanism, cash or credit card. Let's do S9-3. So they give you some of the information in the problem. So if you print this slide out, you'll be able to follow it through in the problems in your homework. You have your units, your price, and then you take that price and you extend it out and given the information in the book, and you get your total sales revenue. So you plop in what the book tells you and you fill in the pieces. Okay, so if you budgeted, if you had the 75 sales price budgeted and then the sales price came in and additional, you had 140, you can see the variation in your mix here. A production budget is units needed for sales plus desired ending inventory is total units needed. Okay, so here's your need. Then you have your units in your beginning inventory subtracted out, gives your units that you need to produce. So this is not new. This is not a new concept. We're going to apply it to budgeting in Exhibit 9-6. So you have your units from sales. Desired ending inventory is your total need, less your beginning inventory is what you need to produce. So you do this for the whole quarter. Okay, so I'm going to click them all on here. And there's your first quarter. Okay, so typically budgets are done in a quarter, and then 4 quarters make up a year because things do change throughout the year. Now look at S9-4. Same thing, we're going to take the sales budget, the desired ending inventory is your need, less your beginning inventory is your units to produce. And you're going to put in what you know, calculate it through, and end up with your quarterly amount. So it's basic math. Very easy to do this in an Excel spreadsheet. Now you do your direct materials budget. Quantity of direct materials needed, desired direct materials ending inventory is your total need, less your beginning inventory is what you need to purchase. Same concept. You're going to put in from Exhibit 9-7 what you know. Let me click them all in here so I can talk about them. Okay, so you have your January and you get down to your desired ending inventory. Okay, and then your ending inventory is your next month's beginning inventory. So you see these arrows, they're done that way on purpose, so you know what your ending inventory is, and then that becomes your beginning inventory in the next month, and then you take it through. The math is all done the same way. And then you get your ending quarter. Notice that your ending month inventory is your ending quarter inventory. And there you go. Okay, so if you do S9-5 and put in what they give you and calculate it away, and like I said, if you set this up in Excel, it does move really quickly once you set up one problem. And it is a nice way to do your homework, even though you do it in my accounting lab. If you have a little template set up, you can test yourself in Excel. Okay. Now you do your direct labor. It's starting to seem redundant here, but that's the point of it. Each one is done the same way, each piece. Now you have labor, units to be produced times your direct labor per unit is your direct labor need, times your cost per direct labor is your total direct labor cost. Now this is really simplified because in a real company you'll have all levels of labor, and it'll be labor times varied labor times varied products, but overall it's the same concept. Units to be produced times your direct labor hours per unit is your hours required times your labor cost per hour is your direct labor cost. Okay, and then you do all 3 months to get your quarter. Okay, and there's your quarter amount. S9-6, so you get a chance to practice on your own, putting in what they give you. There you go. So it's the same math, it's just different things that you're calculating for each piece of the budget. So we've done the direct materials, the direct labor. And here's your manufacturing overhead. Here's just a picture of it. It's your units to be produced, and you put your variable cost in, your indirect labor and your indirect material, and then you have your utilities, which is there's a variable portion. That's your total variable manufacturing overhead. So remember, this is a concept you learned in previous chapters way at the beginning of the course. And now you're budgeting in the same format that your actuals roll in. So this is a little bit of a review. Then you put your fixed manufacturing overhead costs in, and then you have your total manufacturing overhead, which is the total of the variable and the fixed. So you budget the same way your actuals are done. And S9-7 gives you a refresher. So you're going to put the information in for each month. and you're going to get your quarter. So this is all a review. It's just you're doing it for budget versus actual. And here's the operating expense budget. Here's a picture of this Tucson tortilla company. Sales units from, this is your sales budget. Put your variable operating cost in, is your budgeted variable operating cost, less all your budgeted fixed cost, gives you your total operating expenses. So you can start to see that this is a very complex process. It requires a lot of knowledge of the company, a lot of knowledge of where the company's going, future information. And so an accountant can't just sit in a room all by themselves. They need to have that participation from other people. So here's S9-8. So if you try S9-8, then you can check it here. Make sure you did it right. Now you get your budgeted manufacturing cost per unit. This is Exhibit 9-11. So you have your direct material and your direct labor, and then you put in your manufacturing overhead, and you get a cost of manufacturing per case. Then you can apply that to the number of cases. And then here's a budgeted income statement. So you have your sales less your cost of goods sold, gives you gross profit, less your operating expenses, gives you operating income, less your income tax expense. And they just usually in the problem will give you a rate. Now remember, it depends on what state you live in as to whether there's this kind of tax or not. But look in the problem, and that's usually a fixed 35% or something like that. So now S9-9 gives you a chance to practice. So practice and check your work to make sure that you understand it. The cool thing about this chapter is you're not really learning any new verbiage or descriptions of stuff. You're just applying it to a budget world. The third objective is to prepare your financial budgets. The components are your capital expenditures, as I previously mentioned, your cash collections, your cash payments, and your combined cash budget. And in the private sector, cash is very important. Not that it isn't in any other sector, but when you're a for-profit industry, your cash collections and payments are dependent totally on your own operations and nothing to do with government allocation. So here's an example. It shows the company's plans to invest in new property, plant, and equipment. So you have your computers, your delivery vans, your production equipment, and you get your total. Then you have your cash collections. You put your cash sales in, and then you look at your mix, whether you get credit card sales. We're going to talk about credit card in a minute. And they put the credit card sales in, and then you get your total cash collections. Let's do S9-10. So you put in what they give you, the cash sales, and then you have 25% in month 1 of the sale, month 2 after the sale, and well, this is the current month, month 1, month 2, and then your total cash collections. And then you roll it through, the methodology through, and this is how you budget. Why is this important? Because you can't run out of cash to pay for operations and capital, or your business will go under. So honestly, one of the most fluent or frequent reasons businesses go under is they don't monitor their cash, and then they can't pay their bills, and they run out of money. Building a cash payments budget. Here you go. This is what it looks like. Just an example. This is on the page noted up here. Now let's do S9-11. You put your cash payments for direct materials in the month of purchase. Cash payments for direct materials minus the month, and this is the month after purchase. Cash payments for direct labor, direct manufacturing overhead, operating expenses. How do you know this information? You know, the book's telling you what this is. This comes from your historical trends of what your business does, and that's all a budget is. It's based on history, based on what you know, based on estimated changes. So budgeting is actually an art. If you're a good budgeter, the science is what's over here. The art is understanding your historical trends. So notice here, as you flow through beginning cash, this is like a cash flow statement from an operational standpoint. Beginning cash, cash collections, cash payments, borrowings, ending cash goes up to the top. And what flows into all these payments is, here's this coming from Exhibit 915 and 9-14, and this is the summary of it. Then you have your budgeted balance sheet. So you get your cash from the previous slide, your accounts receivable, and you do your budget, and then you make yourself a balance sheet based on what you budgeted. This is a very good slide to print out. Sensitivity analysis, a what-if technique that asks what a result will be if predicted amount is not achieved. And I've been mentioning this throughout the slides. And once again, sensitivity is the buzzword in this book, but it's what if is used a lot. Forecasting is used a lot in the real world. Sustainability and budgeting. Goals for sustainability are reflected in the company's budgets. Long-term sustainability goals affect short-term budgets, and you use a benchmark for judging performance. So like I said, budgeting is truly based on your knowledge of the business from historical past and your understanding of where the business is going and what risk factors are out there. Preparing a merchandiser's cost of goods sold. Service companies, no merchandise inventory. You have operating budgets, sales, operating expense, etc. And a merchandising company has all of the pieces that we're used to with a merchandiser and a cost of goods sold section. Cost of goods sold plus desired ending inventory equals inventory need, less beginning inventory equals purchases of inventory. So that's a refresher from you from previous chapters. So here's an example of a cost of goods sold inventory and purchases budget, just to remind you. What is the impact of credit and debit card on budgeting? The implication is credit card companies and their issuing banks charge merchants a fee. The merchant receives the entire amount of the purchase less the fee. So if you've never worked with credit card transactions, this is a very high level description. The benefits are lost sales if didn't allow the customers to use a credit or debit card. People won't buy from you if they can't use their credit. The decrease the cost associated with the bounce checks. So, if people bounce their checks now, you don't have that. And you receive cash quickly, so it improves your cash flow. So this is really the biggie here. Credit card transactions are consistent cash flow. Here's an example. So a customer prepares clothes for $50 and uses a MasterCard to pay for the purchase. The MasterCard charges a transaction fee of 25 cents plus 2% of the amount charged. So here's the transaction fee. And then the cash deposited is the amount less the transaction fee. So if you remember from financial accounting, the booking of this should be a refresher for you. When preparing the master budget, the merchants need to consider the percentage of sales that will be made using credit cards and that fee, and the length of time between the sale and the deposit. So this is the important part of budget. This is the refresher of financial accounting. A store credit card is there's no transaction fee, but the merchant assumes the risk of collection, and you must wait for the customers to make payments. It could be 30, 60, 90 days. That's why companies like Macy's, they have their own credit card. That's a store credit card as opposed to a Visa or a MasterCard. So cash collections budget is the aging of receivables, and the operating expense budget needs to include an estimate for bad debts. And you budget interest income and late fees. And that's the end of the chapter. So send me an email if you have any questions, print out the PowerPoints, go through every example before you start your homework. Thank you.